You're about to hear my conversation with Benoit Gervais, portfolio manager and head of Mackenzie's resource team. We'll talk about the resource sector, how Benoit views the commodity complex in the near and long term, and the opportunity for alpha generation. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, VP of Investment Strategy and Portfolio Solutions. Today, I'm joined by Benoit Gervais, who leads our resource boutique at Mackenzie. Benoit, thank you for joining the podcast today.
Thanks for having me.
Benoit, it feels like we're experiencing a downward shift in growth expectations in the economy right now. How are you looking at the macroeconomic landscape?
That's correct, Rajan. I think some of our indicators started flashing yellow early May, late April, and that was the second signal we got since the beginning of the year. Obviously, we always look for confirmation. And it looks like the equity markets have been slow to respond to this, at least the broader indices. But when it comes to commodities, we're extra sensitive to some of the more sensitive economies. I'm thinking emerging markets. So when you think that higher interest rates impact the U.S. consumer, they impact extra some of those other countries. So in other words, if the U.S. sets the bar when it comes to interest rates, then everything else follows behind. So if you're in Brazil, you may think you need several hundred basis points above that just to attract capital. So it started to bite early in the year, and we started to take quite a conservative stance. I would say that reflects, if you want, yellow light, not an outright red light, but a yellow light.
How do you differentiate between yellow light and red light when you're thinking about the nature of global growth?
So you want to lose all your cylinders if you want to call it a red light. And there is no recession per se in the US. We're not there in Europe. We're probably there in China, although it's difficult, more and more difficult to call it with the lack of data out there. So we have at least lost one engine, one cylinder out of the engine. That leaves us with the US. That's going to be a tough one to call because the consumer is doing well. The fiscal stimulus was quite good over the past 12, 24 months and likely will be sustained. But will that be enough to make the economy grow and carry places where things look a little bit more difficult, like Europe? We're starting to see some of those economies contract when it comes to commodity consumption. And that's normal for commodities when the world is slowing. It is a late cycle sector. So you would expect that some of the more discretionary spending in those less active countries will shrink their consumption. So steel and iron ore are big barometers today. More so than copper because there's some big tailwinds in copper coming from electrification. So maybe the signal won't be as obvious this time as they would have been in the previous cycle. So iron ore and steel, particularly weak. Oil, which is also ex-growth, particularly weak in China.
Very interesting, Benoit. I want to get into some of these commodities right now, but I actually just want to follow up on your most recent comments. You said iron ore, steel, weak. Now, is that globally? Is that limited to China? And does the level of weakness right now surprise you?
So we've been avoiding some of those sectors. When I say avoiding, underweighing them, because I think we're quite positive on the overall resource space for the next 5 to 10 years. There's some very strong thematics. So really the key word is underweight relative to some of the other commodities. So iron ore and steel has been in oversupply in some regions of the world, in particularly China, because of their difficulties with real estate or infrastructure, the overcapacity that exists there. So it would have been already weak, but is getting weaker. So directionally is what's really worrying us. In the US, things were quite strong. So we sold Stelco earlier this year. Profits look pretty good for the year, but directionally lower in the next 12 months. And it is not a high growth sector. It has its sub-sectors within iron ore and steel, but it's not a high growth sector. So you would expect some of those ones to show the way, if you want, in times of economic contraction.
Okay. And thank you for mentioning Stelco. I promise you, I'm going to come back to that one because I'm already intrigued by the story. Benoit, it's September, as I'm sure you know, in about, let's call it 7 or 8 weeks, big election south of the border. But this has really been the year of elections. I think there's been something like 50 national elections, a lot of geopolitical risk. Certainly a story this year has been sticky inflation. I mention this because I can't help but look at the chart of gold. Can you share with us what's really been going on with gold in 2024 and what are the drivers going forward?
So gold started to do well when some of those countries, which are perhaps either at war with the US or are in conflict zones with the US or in commercial trade wars with the US, so think China, those countries figured out that those US dollars that they held weren't as mobile as they thought they were. Russia, particularly. So maybe it was just aeroplan points that were going to expire on them. They needed a solution. And in particular, they needed to work around the SWIFT system, right? So most international trade clears through that system. And if you're excluded from that system, you have a major problem. At the same time, we have China, which is also trying to be solely dependent on the US. They probably watch what's happened in Russia and they say, things could get worse or could get better, but we need insurance. How about we start a parallel currency system? At a time when the Chinese economy is quite weak, at a time when their citizens are probably asking questions about where their dollars are going because they're constrained back there in limited to the Chinese investment pool of opportunities. So no S&P 500 for them. So you put it all together. You have central banks that need to diversify their currency, create another pool of exchange. And that means you probably need some gold because those pools of currencies are not very big, right? You're not going to use the US dollar. Well, what will you have in that pool of currency as a central bank? Rubles? You can't have too much of this. So you're going to combine that with some other hard liquid assets like gold. If you're a Chinese citizen, you can't do S&P 500. You certainly don't want yuan or rubles. You can buy bonds perhaps from the Chinese government, but then you're long yuans again. So what else can you buy? And gold is one of those few options that they have.
That's pretty fascinating. And these central banks, you've mentioned Russia, you've mentioned China. They have very large needs. It sounds like these are themes that are not going away anytime soon. Is it fair to say that gold will remain well supported in your view?
It's well supported. So it's strong tailwinds from that big movement. So when we call it onshoring, right, for them, it means offshoring.
Right.
And they're not getting stronger. So they need to do something. They need to address this. We're probably not going to change course here on onshoring. And it will go through a wave of expansion on onshoring and stabilizations. But I think we've seen the best of global trade here for a little while. So the negotiation power that China has had over the past 10 or 20 years is eroding away.
I can't help but notice you've named a couple of themes already. You've spoken about onshoring. Earlier, you talked about electrification. I know it's not a big part of the market, but copper's always on top of everyone's mind. Copper seems to have some long-term tailwinds behind it. What's your view on copper right now?
Well, there's a relationship between copper and global GDP, which has been very strong, close to 1-to-1 over the years. And then we've had additional demand that's come through here through this electrification, which probably added 1 or 2 percentage points to this. And then on top of this, lately, we've had this AI investment. Maybe it's turned into a fever when it comes to the stock market, but most of those very large tech companies are building out their centers. Their capacity is increasing, and we're talking very large numbers, which probably adds 0.5 to another percent. So when you put it all together, likely is that copper will grow 2 times GDP over a full cycle. Now, it also contracts typically in economic slowdowns. So it'll probably go flat to up in a global economic slowdown, which is better than historical. And at the same time, we're having what I would say tepid investment in the copper industry, and the copper supply is likely not coming for the next several years, because we know it takes about that 5 to 10 years to build a mine.
Okay. And obviously, we're talking about copper on the theme of electrification. Electrification, in my mind, I think about the energy transition, and I go from energy transition to natural gas. And I have the expert on resources here. Let's talk about natural gas. What's your view on natural gas right now?
So, for a little bit of context, if you had asked the average investor 5 years ago, I think there was this vision that we could do it all with renewable. And as we're finding out, there's some local resistance on wind, less so on solar. There was also cost inflation on wind, but it was also intermittency issues in certain jurisdictions, which caused people to reflect on whether it was, technologically speaking, possible to reach 100% renewable types of grid. And the answer is not. It's just like the electric car. It's going to be growing at a slow pace. They're large investments. And every time you replace an old piece of equipment with a new one, it costs additional fees. Well, that goes into the rate base. And it's also a very political hot potato, if you want, when it comes to the utility bills of the citizens of the US or Europe, especially now. So there is a slow transition. And one of those transition piece of equipment that is cheap, reliable, and is a nice complement, and is also an improvement to coal, is natural gas, right? So you mix it in with all your renewables, you probably chop 2/3 of the emission per kilowatt delivered to the end consumer. You probably keep the cost relatively stable, and you can actually build it. That's the last part. So some of those endeavors are not buildable. Like a nuclear reactor is interesting, but probably not feasible within a 10-year time frame.
Right.
So if you want real actions, and that's what we call it, the transition, right, towards a better world for sure, but it's a transition and it takes time. So if you want intermediate milestones, natural gas comes quite handy for many countries. That's why we're using more and more here in North America, Mexico, and we're trying to export our large natural gas resource through the terminals, the LNG terminals, to places like China, which are using lots of coal, and India using lots of coal, Europe still using coal. So I think that we have probably, again, in the case of natural gas, that has been growing, I call it half GDP. Better than oil at 0 times GDP, right? But now if we were laying on top this LNG cycle for the next 5 to 10 years, you add several percents of demand growth for the next several years. And that's meaningful because most of my stocks are traded ex growth, 0 growth. All you see is the dividend or the buyback. That's all you see. Plus or minus the cycles up and down. Now, if you're starting to think that my stocks have anywhere between 1 times and 2 times GDP leverage, which is more like an S&P 500 average, then it gets pretty interesting given the valuations.
That is pretty interesting. So building the plants is practical and it's feasible. So there's demand growth. It's at a similar price. We can cut emissions. That's a pretty bullish case. How does that compare with the case for oil?
Well, in the case for oil, it has one thing going for itself. It has constrained supply, a well-managed oligopoly in OPEC for now. Most of the companies now have come to this realization that oil was going to be low growth. Maybe they would disagree with me and they would say, well, it's 1 time GDP or 0.5 GDP, but their starting point was much higher. So they're being much more conservative in the way they're spending money, and supply growth is very limited. That's the good news. And they're using their free cash flow from their legacy assets to reinvest in new energy or transition energy, natural gas, right? So that put us in a perhaps a less favorable environment than an environment where you have tailwinds like electrification running at 2 times GDP over a cycle. Now you're running over a cycle at 0 times GDP. If it's well managed and people are rational, you can still make a good return, but there's a bit more risk than in a growth sector.
It sounds like a lot more of this return is going to come from returning free cash flow to shareholders as opposed to future growth projects, which is very different from the natural gas
Absolutely.
project.
When
Yeah,
we divide the investment opportunities making the resource world, we have definitely a contrast between some of those ex-growth industries and expectations that come with this in terms of return of capital and capital allocation from those who have growth opportunities. So those who do not, then we say return the money to shareholders. We will take care of this reinvestment in other industries, right?
right,
So, and that's why I think in good part, some of those pure oil companies are trading perhaps at too low valuations, I may say, because they're still giving you double-digit returns at a reasonable oil price. But it's not like it's a high growth sector that should trade an S&P 500 multiple either.
right. So you just mentioned low valuations earlier in our conversation. Made reference to Stelco. Sounds like that was an opportunity that you got in when the price was right. Can you provide some context on the story of the investment thesis in Stelco?
So Stelco, for those who don't know, Stelco is a local Ontarian steel producer, one of the lowest cost blast furnace. And there is a new way to make steel today. It's from recycled steel. This one is making it from a blast furnace. That means they're putting coal into this, right? And it has large emissions. And I think that it was highly discounted because people thought that a large tax bill on emissions would be coming. But the truth is that once there is a legislation, then countries like Canada and the US are trying to make it even. If you're getting steel from China that has double the emissions that we do, would it be fair to ask our companies to bear the entire cost, takes the emissions down to zero, and let all of those dirty tons come from China? The answer is no, obviously. And that's what they did. They put large tariffs on Chinese imports because inshoring is tightly interconnected with climate action, right? You are asking your companies to perform and progress towards a better world. It costs money. Now you can't just undercut them by allowing imports from, call it, dirty players. Yeah. So that has led to a differentiation, if you want, between the good performers, global performers, and not so good performers in the way they sell their tons. So a ton in the US sells for $100 to $200 per ton, which is not much. You work out per pound is like 10 cents, or something like this. Butter sells for $5. So, but 10 cents makes a big difference because those automakers will nickel and dime you for every penny. And at 10 cents is actually double what your historical profits were. And that really changed the environment for that industry and repriced, one, the profits, and two, the growth prospects. You could grow through onshoring and removing import tons into this market. That's a much more appealing industry setup than you would have had. Yeah. So then I think that it was still trading at very low multiple. Like, for those who know the accounting terms, EBITDA is 2 times EBITDA, less than 1 times profit because people didn't believe that it was a sustainable profit. Somebody paid 100% premium for that business, and I still think it probably works out to a very low multiple for the buyer.
Great find. Benoit, I have one last question for you. When I think about the Canadian market, energy materials represents nearly 30% of an equity allocation, at least if I look at the index for a Canadian investor. I want the perspective of portfolio manager. How should I think about managing exposure to this part of the market?
Rajan, it is definitely a less traveled route. Most people find their exposure in resources through a broad purchase of the TSX XIU would be one of the very popular ETF here in Canada, and would find in there 30% of that TSX being resources. What few people know is that in that index, there's about 8 names making 60% of your allocation. So 8 names making about, call it 20-ish plus or minus percent of your portfolio. And that's really your call on resources. I would say is highly insufficient in terms of diversification. So if you're giving it a bit more thought, and we've done that for many years, 22 years here at Mackenzie, managing Canadian resource, but also global resources. We certainly have champions in Canada. I do not want people to think that Canada does not have great resource companies. We do. In many sectors, we do. Couples, we are largely absent. Perhaps in chemical lands, it would be not so represented in the TSX. But what we found out with Stelco is that Stelco does not look like Enbridge. And a copper company does not look like Nutrien. And we know that because there's the opportunity set in resources so diverse, and I think we've talked about this today, between the X growth, some growth, and high growth, then you probably want to have diversification and have exposure to more than just those 8 or 10 names that may represent. And that's probably a very fertile ground for us active managers to go and find companies that have those opportunity sets that do not sit at Suncor. So we ran actually a quantitative test to compare the idiosyncratic nature of the sector in comparison to that of the S&P 500 and the TSX. And what we found is that a regular off-the-shelf, I would say, risk model would explain 2/3 of the performance on the S&P 500. But when it comes to that same off-the-shelf model, it can only explain 1/3 of the performance of resources. That tells you that not many people are paying attention. There's more opportunities for alpha, and we know already as Canadian that is also a less traveled route for most global investors.
Benoit, that's great. I love that you finished your thoughts there with a reference to there's more opportunities for alpha, because I completely agree. And I think our conversation today has really brought that out. And you opened with the benefits of diversification. I also didn't know the 8 names represented such concentrated exposure. Benoit, thank you very much. I've really enjoyed our time together today. I've really enjoyed this conversation, and I look forward to us chatting again.
Always a pleasure to be here.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.